As an investor, it's very important you consider stock liquidity before you invest. That will make it easier for you to buy and as well sell the shares whenever you want to without necessarily affecting or altering the price of the stock. When you consider this particular topic under a number of subheading, number one here is an introduction to stock liquidity. Introduction to stock liquidity. So liquidity actually is the ease with which you could buy and sell shares in the market without altering the share price. You could very easily sell. You could as well buy, even in large quantities and without altering the share price. Number two is key factors to assess liquidity. Key factors to assess liquidity. So in this case, you consider the average daily trading volume. The average daily trading volume. This is the total number of shares that are traded over a set period, usually within a day or a week. And how do you really check the average daily trading volume? You could then check this in platforms like Yahoo Finance or Google Finance. Usually, you have a high average. For example, it may be as high as millions of shares. In this case, it indicates that the stock is highly liquid if it could trade millions of shares, per week or per day, as the case may be. You also look at the bid-ask spread. The bid-ask spread is the difference between the bid price and the ask price for the shares. So generally, if the difference is very wide, it means the stock is somewhat illiquid. But if the spread is very low, that stock is considered to be highly liquid. You may also take into consideration market capitalization. So large cap stocks, that's stocks with market cap above 10 billion, tend to have tend to be highly liquid than small cap stocks because of the number of shares outstanding. And not only that, you may also look at the float. This is what is called float. Float here is the number of shares available for public trading. Number of shares available for the public to trade on, excluding those held by insiders and large institutional investors. Generally, when you exclude, the stocks held by pension funds, big mutual funds, hedge funds, whatever remains is called the floats. And these shares are generally available for retail investors to trade on. Number three, other methods of evaluating liquidity. Other methods of evaluating liquidity. You have the order book depth. The order book depth. And this is the list of buy and sell orders in the market at various price level. Look at the sell side, the volume involved. Look at the buy side, you equally look at the volume involved. So in this case, it's a list of the sell and buy orders in the market at at different price level. So a deeper order book with numerous buy and sell orders at different price points indicate high liquidity. This morning I was trying to dispose a relatively large volume of shares. I couldn't do it because on the buy side the liquidity was somewhat low. So I had to, you know, uh, sell in tranches, in small units, because there wasn't enough liquidity to absorb the large quantity I wanted to sell in the first instance. You also look at slippage analysis. Slippage analysis. This is the difference between the expected price of a trade and the actual price at which the trade occurs. This happens in the case of a market order, So you may want to sell your stock at a particular price, but unfortunately, the order could not be executed at that price. It might be executed at a different price altogether. It is called slippage analysis. So the degree of variation in the stock price over time, that is what volatility is all about. In the case of volatility, it is at the degree of the variation of the stock over time. So generally, stock, tends to like this. That's volatility up and down, and it varies, from time to time. It's up this time around, down, up, down. That's what volatility indicates. So for you to be able to, check volatility, you need to review historical price charts to understand the stock's price, swing. You look at, the historical chart and see how the stock had performed, in time past. Number 4, practical tips for investors. What are the practical tips that could help investors navigate this issue of liquidity and illiquidity in the market? How to assess liquidity before you make up your mind to invest. So in this case, you look for stocks with high liquidity. If you plan on trading frequently, if you want to trade frequently, you can't do that in an atmosphere where there's insufficient liquidity. So you must consider, stocks with enough liquidity to be able to execute your trade, as the case may be. So you consider the timing of the trade. Consider the timing of the trade. So in this case, liquidity can vary during different periods, in the typical trading day. So like in the early phase of the trading day, you may not have enough liquidity. But as the day progresses, you come across a time where, liquidity will tend to increase, in the course of the day. The market tends to be more liquid during regular trading hours and less liquid during, off peak hours. So generally, in the early phase of trading, you may not have enough liquidity, but as time goes on, you will have, enough liquidity to trade your stocks easily. And so you may also use limit orders. If you are trading less, liquid stocks, limit orders can help control the price at which you buy or sell. By so doing, you minimize, minimize slippage. If you want to really avoid slippage, that slippage here means, selling or buying a stock at the price you don't actually wish to buy or sell. At a price other than the actual price you would have loved to buy or sell that particular stock. So to limit or minimize slippage, you set a limit order. This is the price I want to buy, or this is the price I want to sell. So in that case, you'll be able to, buy or sell at that same price. So in conclusion, the key factors for assessing liquidity, involve average daily volume, bid-ask spread, market cap, and float. So emphasize the importance of liquidity in reducing transaction costs and ensuring you can easily enter or exit a trade. So generally, in the case where there's illiquidity, transaction costs will really increase because of the bid-ask spread becoming too big. The bigger the bid-ask spread, the more the transaction cost. So it's very, very important to take this into consideration as a trader or as an investor.